Don't forget that. Welcome to Silvercrest
Okay, we are
Opportunity
here
Fund.
today on the Win Mobile Homes Mobile Mailbox Money Silvercrest Opportunity Fund Mastermind, centered around Arizona real estate today. Have a good friend and operator as a licensed real estate agent out with us today to provide some market data. Kristian Berry. Kristian, if you could just introduce yourself real quick, possibly how we know each other, and we'll kind of get into some topics that we'll go over today additionally. But just go ahead and introduce yourself, Kristian.
Hey everybody, I'm Kristian Berry, a residential realtor in Scottsdale, Arizona. Alden and I met a long time ago when we were kids in school, but we both are actively in investing in real estate. So, yep.
Happy to have you here today, Kristian. We met back in, I think, middle school of all things, back at Copper Ridge in North Scottsdale. So great to have some, lifetime relationships out in the market. Kristian's family has had long time real estate expertise across the nation, Iowa, here in Arizona, dealing with investment properties as well as first-time homeowners. So happy to have him here today. Just some quick house cleaning. We just got back from the Directed IRA Summit hosted by Directed IRA. So that was in Austin, Texas. We recently attended in Ponte Vedra, Florida, the Wealth Protection Summit put on by First Shield Financial, Jerry Sanders. So that was great to go out and network with other note investors and high net worth individuals actually looking to invest out in the market. A lot of volatility going on, and people are looking for alternatives. This weekend, actually leaving here in the next 2-3 hours, we're headed to Nashville, Diversified Mortgage Expo. We'll have a booth. We'll have the cameras and lights out getting hot takes from individuals in different industries, note investors, hedge fund managers, and things of that nature. Nathan Turner, we actually had previously on one of our masterminds. So he's a hedge fund manager and owns Diversified Mortgage Expo. So kind of just give you a little taste of the people that we have on, what kind of market information we provide, and the opportunities and events that we are attending. Oh, we got another attendee here. So, Kristian, appreciate having you here today. Oh, we got multiple other people here logging in. Just give me one moment here. Appreciate all the new joinees here. I was just going over how we've attended, a couple other conferences, and then Diversified Mortgage Expo this weekend, really big. To preface that, if you're at all interested in attending, definitely worth attending. So today, our main topic is going over the Arizona real estate market update. Me and Kristian have gone and talked about the Cromford a few times. Isn't that right, Kristian?
Yes, sir. Yep. No, yeah. That's a lot of reaction too, which is good.
Yeah, people want to hear what's going on in the market. Why? Because, we want to be able to make a savvy decision, whether that be in a path of progress or a emerging market, or just make sure that we're hedging either with rental rates and purchase prices and things of that nature. So those are on my vlogs. And those can be found. I should have the vlog number in front of me, but I don't. If you want to check those out and see how the market has progressed over the last 2-3 quarters, so that me and Kristian have facilitated this information, reach out to me direct or shoot it in the chat or contact Sunny, and we'd be happy to send you those direct links just to kind of see, market information of fluctuations in what purchase prices, average days on market, in Phoenix, Tempe, Mesa, Glendale. Oh, shout out to Mark in the chat here. See DME. Happy to see you this weekend. So, Kristian, let's kind of dive in here. I asked you to kind of bring some market data where I think we're all eagerly anticipating what these numbers are going to be. And I think a lot of people have some preconceived notions about the Arizona market and volatility, in purchase prices and things of that nature nationwide because of other circumstances. What are some of the markets that we'll dive into today, and maybe just some pertinent, or is it list price and days on market? What are we providing today?
Yeah, we can go through both of that. Basically, what's active on the market, and markets as Scottsdale, Phoenix, Chandler, Mesa, and Gilbert are the main ones we're going to go through, as well as days on market, months of supply in those markets, and listing success, how much success they've had listing the properties and if they've gone through. And then sales price, of course, we'll go through as well.
Let's start with Scottsdale. Scottsdale's, historically a high number, a desirable market. We hear currently that uh, luxury properties are not seeing so much volatility. They're actually increasing in value tremendously. Kind of some people fix and flipping some residential luxury properties that I talked to, kind of quoting some market data. Let's dive into Scottsdale.
Yeah. So Scottsdale, it's surprisingly the days on market for sales are going down. So that what that means is if you price your property right and at the right price point, then it's gonna go within 2 months, 3 months. So if you don't, it'll take another 30 days to stay on the market, and eventually your price will probably drop, and you won't get as much appreciation in that. So
So days on market are 60 to 90 days, or really average 60 days, it sounds like in Scottsdale. And then if, priced a little bit above, where market would support, you're seeing a little bit, maybe that extra month it takes to get the financing, or, maybe it didn't appraise, or, all kinds of situations that may happen.
yeah, definitely. And then what surprised me too is the median price went down in Scottsdale. Only went down $1,000, but that's still a decline. So we haven't seen that, and I think maybe at least since last quarter. So
Yeah, definitely. We saw appreciation the last time that we talked about the Cromford. I remember. I can't remember what the average purchase price was. It was probably around, half a mil, 460, 475, something like that. That may have been the Phoenix market.
yeah.
What's average per? Do we have that number now in Scottsdale?
Yeah. Oh, and in Scottsdale, you get that's the thing is it 1.17 is the median sales price at Scottsdale.
So that's the average sales price in Scottsdale, 1.17, and it's gone down $1,000. So we see some market softening, maybe a little bit of a plateau. Not heavy dips. Florida's seeing some heavy dips. California, people kind of try to get out of that market at any given time. So we saw huge appreciation over the past 5 years, from COVID and all the stimulus money and the new desirability of the market. So that's kind of interesting to see, how it's developing. So 1.17. Sorry, I got a couple text messages flying back and forth. So that's Scottsdale, Arizona. Is there any other number that we missed on Scottsdale?
Pretty much so the listing success rate, which is really, really important. It was last month, 80% listings sold, and it went down to 69% this month. So you're seeing obviously people are overpricing their listings and not getting them sold and canceling or letting them expire. So I mean that's really good for the person looking to move into Scottsdale and just can't afford it right now. So
some competitive situations, it sounds like, to be able to come in and shake a deal at the end of the day. So that's Scottsdale. Let's dive into maybe another couple markets that we have. What's next? Do we have?
let's do Phoenix, which everyone loves. Like we said, 2 months for if you price your property right, it'll take 2 months and it'll be gone. If you overprice it, it'll take another 15 to 20 days on the market. So if you can afford that,
Yeah, do me a favor, pick up that mitt for me.
people can't. But
Do me a
there
favor, pick up
are
that mitt for
3
me.
months of supply in Phoenix right now, which is shocking because you'd think there'd be a lot more inventory, but the demand is still high. So Phoenix, the median price is 485,000, which is staying pretty normal. And I think that's it for Phoenix.
So that's for the Phoenix market. We got a question from Mark. We'll touch on the mobile home market here after we touch on the residential market. So kind of give you a broad spectrum of what the market looks like in different industries, from single family down to manufactured housing, which we focus on is the affordable home ownership program. So Mark, we'll get to your question here in just a moment. So that's the Phoenix market. We went on days on market, seeing, some still desirability of people facilitating transactions in the Phoenix market. Did we miss anything on Phoenix?
No, the listing success rate's it's staying around the same, 77%. So, you just got to price it right. It's very important to make sure you price your property right when you're listed up.
So being realistic, making sure your comps are accurate, all really important, pertinent information for success.
Yeah. understanding what you're competing against, you know?
And we got Mesa next.
Yeah, let's do Mesa. So the average median sales price for annual sales is $494,000. And I think that is up a little bit. Just about $1,000 from last month.
Thank you, Daddy.
But there,
Thank
you
you,
know,
Daddy.
everything's pretty consistent other than, you know, Scottsdale. They're all seeing about 2 months on the market, 3 months if you're gonna overprice it. But everything, it's becoming a balanced market for the first time since 2011. And, you know, supply is up 40% and the demand remains, you know, it's still not where it needs to be. So that's why we're seeing people overpricing and staying on the market for a little bit longer.
So that was Mesa. We do a lot of business in Mesa, but we'll leave that for here in a moment. Let's keep on track here. What are the other? I think we had 2 more markets that we're going to discuss here this morning.
Yeah. Let's do Chandler, which is really exciting. They're actually moving a lot quicker, 55 days on the market. And they're used to they last month it was only 2 months of supply. They went up to 3 months of supply in Chandler. So the demand's still there, but the supply is rising a little bit. And you know, their median price for annual sales is 565,000. So that's staying about balanced as well. And then for Gilbert, surprising, 605 sales price and 60 days on the market for average sales. And then listing success is, you know, just down about 10%, just like the rest of the markets.
Yeah. So a median market is 90 days on the market. It's tough to adjust our thought process a little bit at any given time because we've been super blessed, but also spoiled in the markets that we've seen the past 5 years of stuff flying off the shelves and things of that nature. And this kind of feels uneasy, I think, for a lot of people, you know, seeing how the market has progressed over the past 5 years, but seeing some staving, you know, of market growth and residential pricing and really even, you know, opportunity here in the Valley. So I think a lot of people are waiting for information like this in order to make a savvy decision. You know, James is my partner, a long time residential real estate, been in all areas of business. James, kind of what's your take on the current market? You know, I've learned a lot from you over the years, you being my father and all. So, you know, what's your take?
I think I think it's good to take a look at what's going on in the single family housing market. You know, our primary business model in this conversation is to get an idea where the note market is going to lay out. Note market is relative to pricing first at single family. Then the most critical thing on the market for us in the low cost housing space, which is manufactured homes and parks, is really relative to not necessarily the sales price, but what the market rents are. And we see across the valley market rents holding very stable, especially, you know, it's the same story with the Blackstone and all the hedge funds buying up low priced housing across the country, which continues the ultimate goal of the institutions, which is to make the new buyers really not be buyers and turn everybody into a renter for the rest of their life. So home ownership has really, at the end of the day, has gotten out of control and unavailable across the country, including the Midwest market. And that being said, it gives a new braided opportunity for low cost housing, and that's what we want to base it off of. Where is the rental market? Yes, first, what are sales? Are sales still strong? And that's great. But really, what's the rental market and are rental prices holding up? As long as rental prices hold up, which we believe they're going to hold up probably past our lifetime, it doesn't matter what's happening in the economy overall. The institutions are holding pricing up and as long as rental prices are up, even low cost housing is going to stay strong throughout our lifetime, really.
So to just kind of corroborate, for the people that are looking to make a decision, people think a market's going to crash, residential pricing is going to cut in half. Well, there's this new institutional appetite in residential single family properties that hadn't been apparent until really like 2020, and they lost billions of dollars in the stock market, had to figure out where to hedge their money additionally, so had new appetite in buying single family properties, and they want to own 40% of single family properties in the nation by 2030. So by the time pricing falls to a certain level, they'll just come in and gobble everything up and then turn people to renters. Well, what does that facilitate? That it facilitates here in the Valley an unaffordable, program, and in the near future, and possibly even farther, of little to no alternatives in ownership here in the Valley. And how does that tie into here at Mobile Mailbox Money and having market pricing in conscious? Well, we're trying to hedge our bets in the affordable housing solutions that we're offering here in the Valley, and riding rental rates. If we can match or beat market rent in a note and lot lease for ownership to a qualified borrower, that's a super win. And that's why we're even sitting here talking today about purchase prices and things of that nature for the individuals that don't qualify for a residential purchase or want to invest in a cash flowing consummated qualified note. That's why this information is so pertinent here today. The average working Arizonan makes about $60,000 a year. And to just qualify for, say, the lowest average purchase price here in the Valley was like $475. You got to make $80,000 a year with little to no debt. If you make that and you don't want to buy a mobile home, call Kristian Berry, because he'd be happy to have you buy a single family property. But in manufactured housing, it's becoming more and more hardship for an individual to qualify because of where market pricing is and the new institutional appetite in single family properties. By the time they build with labor and material costs a multifamily project, it prices it out of the affordability for that end user, and it's no longer a $2,000 rental, it's $2,500. So that's where manufactured housing fits within this conversation. And just to kind of give you all a little update, like with Win Mobile Homes, of what kind of sales we're doing here in the Valley, average purchase price of a manufactured home on leased land is about $100,000 in a family park that's institutionally owned with city water, city sewer, city trash. They have on-site amenities, like almost like a condominium environment. I appreciate the new joinee here, but it's about $100,000. Right? So the alternative is buying a single family property for $460,000. They may not be able to qualify. What's their alternative to buying a property? Is renting at $2,000 a month. Well, if they can buy a mobile home in a park with granite, new cabinets for around $100, right, and ultimately match or beat market rent at $2,000 a month and have ownership here in the Valley in like a Mesa, Tempe, or Glendale component, that's where our success lies, and where kind of average pricing is falling in family parks. We've seen some hardship in 55 and older. I think a lot of 55 and older individuals are really kind of seeing some hardships because of increased in grocery pricing and things of that nature. So the people that have lived in these mobile home parks in 55 and older environments, communities, age qualified, are seeing some hardship. So that's showing us, ultimately opportunity to come in and refab those homes, get them for a negotiated price, and now provide it to a new criteria buyer. Who's that buyer in a mobile home park now that is forced into a new solution for housing? It's now no longer a mobile home buyer. It's actually a renter who can't qualify for a residential purchase. So in manufactured housing, it's previously known as like trailer park boys, the classic individual on fixed income, Social Security, that's all they have. Their one income, they're making $2,000 a month, and they bought this house 20 years ago, and they've lived there this whole time. Well, now with the new environment of Arizona being a new desirable market, but also the institutional appetite in residential property, the increase in rental rates, it's a new frontier and buyer base for manufactured housing in 55 and older specifically. It's just the people that can't qualify. So average purchase price of a 55 and older home is anywhere from 50 to 75,000 bucks. And that home can be financed for match or beat market rent. So that's kind of a little comparison of a single family pricing where rental rates are in Mesa, Phoenix, Chandler, Gilbert, as well as some manufactured housing pricing in those 55 and older and family parks. Really pertinent information. We had a few sales last month. I think we had about 5. We sold $135,000, 132.5 4-bedroom manufactured home in a family park off major cross streets of Kyrene and Baseline yesterday. So that property actually closed via seller finance, and that's our main business model. What do? We buy, rehab, resell, niche market manufactured housing on seller finance terms and look for private capital amongst our peers and accredited investors either in the fund or by a single note here in the Valley. So that's creating a bank quality note in the hedge of affordability issues here in the Valley that we're seeing, as well as the availability of quality housing in high desirable areas here in the Metropolitan Valley, virtually non-existent. So for $100,000, an individual can buy a home for match or beat market rent, and an investor on the back end here, mobile mailbox money, can buy that mortgage. Did you know you could buy a mortgage? Really interesting revelation I've learned over the past couple years. But buying that mortgage gives you a hedge in the affordability issues. Did you know affordable housing is state of emergency right now, nationwide, not only here in Arizona, but other markets as well, and where does that ultimately fit within one's portfolio? And I see the money sign flying. Smitty, appreciate a little feedback there. But we're here at 12:24. I'm going to open up just to some light comments. Does anyone have a comment of what they're seeing in their market? What kind of other markets do we have here in the room?
Alden, before we hop into that, I just want to, because we talked about single family housing pricing, and a lot of people don't understand exactly what we do in regards to values of manufactured homes and parks and how that relates to single family homes, because they understand we have a lot of note buyers that by history have bought in the Midwest. They bought a note for 50,000 on a property that was worth 40 to 50,000 bucks. They got a 6 or 7% note that was for 20 years. It was a single family home and the house was worth 50, and 10 years from now is worth or previously was worth 50,000. The pricing never really went up. Now those prices for Midwest market homes, say Chicago, Indianapolis, have all gone from 50 to 200,000 because the hedge funds bought them up and they raised rent rates. Well, if you take the same concept with low-cost housing, manufactured homes and parks, the houses in the parks get remodeled just like a single-family home. Say it's a 1970 manufactured home is similar to a 1970 single-family home. You've got to fix the house up. You've got to fix the plumbing and the electrical and the AC. You've got to do a rehab. Our standard rehab on a manufactured home, it's about 1,000 square feet, and we're going to put anywhere from $30,000 to $75,000 inside that property to sell it on average of anywhere from $70,000 to $125,000 at the max. But a lot of people have this misconception about if I take a note on this, that it's a manufactured home, it's just going to get destroyed immediately, and that's an incorrect statement. It's really based off of the quality of the occupant and them going through what we call a double qualification process, which we don't really mention a whole lot. In today's market in manufactured home space, 99% of the parks, or not, at least 90% of the parks, are owned by institutions, and they've really raised the level of requirement of people getting qualified. Not just anybody can get qualified to buy a home in a mobile home park. So they first have to go through the qualifications to get approved to live in the park. And some of the critical criterias, what are they? You have to have a 600 plus credit score, which is really critical, The average consumer across the country probably doesn't even have a 600 plus credit score because of these price hikes of cost of goods and so forth that are going on. But the parks are requiring a 600 plus credit score, never had an eviction, no felonies. So they look up criminal history. They look at 2 years proof of income. They really run them through the ringer because they don't let just anyone get approved in the park. Then once they get approved with the park, that's an institutional approval. Then that buyer comes to us to get our Dodd-Frank qualifications. We use a third-party company to run them through Dodd-Frank compliance, which runs through debt-to-income ratios, credit scores. They have to have an explanation of how their income comes in over the last couple years. So they have to get twice. They have to get qualified twice. The benefit of that, oh, I got some balloons. The benefit of that, and we want to convey this knowledge because I think that this is what I call nugget information, golden nugget information to know. It really opens your eyes of, hey, this note on this manufactured home isn't just, we just ask the person, hey, you got a couple $1,000s down and you can make a payment. Okay, you're qualified. That's not correct. And somebody asks, are you Dodd-Frank RMLO based in Arizona? I think it asks. And yes, we do have a RMLO license that we run through the third-party Dodd-Frank compliance. So I would say probably 85 to 90% or 9 out of 10 people get qualified through Dodd-Frank compliance. The license gets signed off and they're good. And those are the best loans to have, somebody that's been Dodd-Frank compliant. So remember, they had to get first approved through the park. Not everybody gets approved with the park. And then they have to get approved with us for the loan. So we firmly believe that that loan becomes more of an institutional buying purchase loan. The quality of that loan has really raised up because the mobile home parks, since they're institutionally backed, they have really raised the bar. So they're not letting just anybody get qualified in the home. So as we put notes out there, most of those notes will let you know if it's Dodd-Frank compliant or not. But you do want to look up and monitor, the acquisition. Our fallout rate is like 1 to 2%, and it's very, very small. And we're excited about that because at the end of the day, we're a note investor also. We hold some of the notes ourselves. And the main goal of what? The note investor, what's the main goal? Is for the note to perform, correct? I think there was another question. I can't read it on here.
So we're gonna pepper through these questions just real quick. So do we ever mobile homes on land or only in parks? Our primary business model is leased land, manufactured housing. We've acquired some dual purchase, so residential, real property, and manufactured home permanently affixed together. And the reasoning for us staying more in personal property is because it's hedging in the affordability issues we have here in the Valley. By the time you get a lot mobile home, it's like, $250,000, and the paper doesn't make sense. Well, really, we're in it for the long-term cash flow, and the affordability of the unit that we sell on leased land affords us a higher yield return on the paper that we originate to the borrower because it was a more affordable price point. So we get blessed in personal property manufactured housing because we're hedging in the affordability, but also the higher yield on the capital investment. Just for you guys information, an RMLO is a licensed mortgage officer. And why is that important in a note? Well, when an LMO stamps off on a note and it's underwritten to a specific criteria, did you know that makes a note a bank quality asset? It's actually underwritten in this aspect, where in comparison, residential properties only go through one underwriting criteria, and they may have an eviction on their record or something of that nature. Highly unique, right? Bank quality asset with a licensed mortgage officer, underwritten twice with a first lien, only lien on the title, with a higher than average yield on the paper. Got those two questions out the way. What is the ownership level when buying your notes? This needs to be explained in layman's terms, realtor terms. Good question. And are we a landlord, co-buyer, full note holders, or what? That's a great question, Noel. Appreciate your input. So the ownership level from the buyer's standpoint of the note, when you buy a whole note, You are the lender within that component. So you position yourself actually as the bank. The bank has no ownership of the property. They have no maintenance, management, property insurance, property taxes. They just collect payments. Where the homeowner, who we created, has to ultimately list the lien holder on their insurance policy, right, as the loss payee, but also pay property taxes, upkeep the property, pay, all obligations due to as a homeowner, ultimately. There's multiple nimble ways to invest within a note. We come to find out, and that's why we've attended DME like we're going to this weekend, come to find out there's multiple ways we can sell a note. And we can also start a fund, which we've done here at Silvercrest Opportunity Fund. We got our banners packed up right now. But the 3-4 ways an investor can participate in a note, really important. Being a lender, becoming the bank. Right? So for a non-accredited investor, they can participate on a per note basis. So they either buy a whole note within their portfolio, say about an $80,000 acquisition, they buy for $80K, they put their collateral on title, which means they have their lien position, their security, right? First lien position, it goes within their portfolio and they own that asset as the lender. Right? So they position themselves as the bank, and that's within their portfolio. It goes off of our shoreline, right, to their capital portfolio. And ultimately, they're subject to the terms of the contract and ultimately the fulfillment of those payments, right? So those terms are on average 20 years. You could buy an $80,000 note for a 20-year term, say at the rate seller financed, subject to performance, the yield on that paper is 14%. So you could buy a whole note subject to the terms of the contract and repayment and yield annually about 14%. Subject to the buyer performing. The buyer's performing because they double qualified. You positioned yourself as the bank. You own that note for 20 years and you receive your passive payments via automatic funds transfer services every month on, say, the 5th to the 15th, depending on when the servicing company ends up divvying out that payment, because the borrower pays on, say, the 1st or the 5th, just for rule of thumb, right? So that's buying a whole note subject to the terms of the contract. As a non-accredited investor, you bought one note, no portfolioizing of debt. You bought a single asset and move forward and collect your payments in a 30-day program, right? Because it's a consummated, cash-flowing, qualified note that we originated in the local market of Arizona, and that's why the information is important here today. What's another nimble way a non-accredited investor can invest in a note or buy a note or become a private lender? Did you know the term hypothecation? Hypothecation means to pledge an asset in order to garnish capital investment, right? So on that same note, that's consummated, cash flowing, qualified, high yield, I can pledge that asset to, say, Mr. Ron Mora here today for an $80,000 balance. He makes, say, 10% on the yield of that note, and we hypothecate it, make 4 on a vested qualified operator situation. Here, licensed dealer, manufactured housing, one of the largest in the valley. You have sales staff, back office management, and things of that nature. That advantage is for an individual who may not be a note investor and doesn't want a 20-year term. That's a long time, right? To have a illiquid asset for a 20-year term, that doesn't work for everyone. Maybe they're not doing it in an IRA, right, for long-term retirement savings or something of that nature. They want the income now, and they don't mind paying the income tax, and they're not a note investor. They're really a private lender with money and want a collateralized investment opportunity with an income-oriented investment strategy. 1-year term, boom. Vested partner, boom. Asset, you got your collateral, boom. First lien position, only lien position, vested partner with a qualified operator. Huge, right? Competitive return in a collateralized investment outside the stock market. That's a non-accredited strategy, non-portfolioized. So we didn't pool the money. We agreed on one asset, about an $80,000 acquisition, and for a 1-year term, you earn monthly. And at the end of the year, we have an option of either going liquid, selling the note, or maybe you auto rollover, maybe you buy that note 100%. Those are all varying conversations to be had within a 1-year term, right? So that's called hypothecation. And if you never heard of that, it's worth writing down, definitely worth kind of exploring a little bit more. In the fund, so off of our success of doing 300 transactions here in the Valley, and 150 seller carry finance notes with double underwriting and things of that nature. Bernard Moe's got a question about what happens if the family misses payments. Well, over our long track record, we've had a few that actually have fallen out. It's a highly unfortunate situation. The availability to mitigate loss or even make profit, varies on project to project, how seasoned the note was, how much money we got down, and things of that nature. So in these strategies, and we'll touch on the fund here in a moment, right? So Silvercrest is in the waiting room right now. So with the hypothecation and a single note acquisition, right? An investor either buys a whole note, maybe they were a note investor, they're subject to the performance of that note. Anyone that buys a note from us at cost, if that note goes non-performing, we provide them the availability of our back office sales staff, management, retainer attorneys to ultimately reperform and recash flow that asset. Really, the ideal objective is to do that same thing all over again. To get another seller finance buyer, we originate the same note and go from there. It's about a $3,000 fee with 2 months of back rent and one $650 attorney fee to Hull and Holiday. If you call them, they'll want a $5,000 retainer. We'll help you skip that. It's about a 40-day repossession. It's not a foreclosure. It's personal property manufactured housing. Here's your comparison, right, of a residential property and actually a manufactured home, personal property. Repossession, 40 days. We've confirmed that with multiple institutions that own mobile home parks, our attorneys, and things of that nature. We're not in the business of taking people's houses back by any means, but we have recourse, right? So we've taken a few back. Our objective really, once someone misses a first payment and really the only payment they've ever missed, a lot of the times we either defer that, throw it on the back of the loan or something of that nature. In order to us, we just want the performing paper at the end of the day. So at cost, if an investor owns a whole note within their portfolio, they will receive our utility within the licensed dealer of manufactured housing. So they get the tools at their disposal in order to put the home back out for sale, have a qualified agent actually market that home for sale, and probably will help you most likely sell it again on terms and get it back performing at the high yield, right? If someone invests hypothecated, they'll most likely go deferred at that time. So say we hypothecated a note, like I said, just for example, not picking on you, Mr. Ron Mora, that return would go deferred at that time on that specific unit. If we have the funds, we'll pay it, but most likely it'll go deferred for the success of the project to actually regain and possibly make additional profit or mitigate loss within the program. Us being the vested partner, we take that risk as a hypothecation, ultimately, to reperform the asset, and at no cost to the investor, we reperform the home, either go interest accruing or just keep paying the note. We've kept paying the note previously, just in sake of convenience, and had the availability to do so. This success of hypothecations, selling notes, doing 300 transactions, having a low default rate has allowed us the opportunity now to start a fund. It's an accredited investment fund. That's a 506c. And currently the availability is for a passive accredited investor to make a passive bank quality return, and at no cost to the investor. If a note goes non-performing, reperform the asset. The great thing about the fund is it's a portfolio of notes. So opposed to being subject to a single door, maybe you have 10 of those, or maybe you have 2, or 100, you're subject to those notes, right? Within the fund, me being president of Silvercrest Opportunity Fund, invested partner in Win Mobile Homes, I reperform the asset at no cost to the investor, and you make 10% net 10% for a 1-year term paid monthly, or a net 12 for a 3-year term paid quarterly. And that's a minimum of 50,000. Great time to discuss that, as we had that question just now in the chat. So it's a $50,000 minimum to be accredited. You got to have $1 million net worth, excluding your personal residence. $20,000 a month in individual income or 30,000 in combined. It's like 200 and 300 are the benchmarks. And we're currently raising right now. I got a soft commitment on Wednesday from an individual I met at Azria, Arizona Real Estate Investors Association, worth mentioning. Definitely a great place to get out and meet people and talk about the market, get market data and why affordable housing is such a great place to hedge. We're trying to grow this portfolio of notes to $5 million a year. So we're raising currently 50,000 to $1 million. I could ultimately help you earn in a 30-day program. Why is this so highly unique? We're not just the lender. We are the boots on the ground, procured the unit, found Ginnie Mae. Ginnie Mae qualified through us. We seller financed the unit with third-party underwriting, set it up for automatic funds transfer services. And every time I receive money, I have a pool of like 4 or 5 notes every single month that I get to shop and take my pick and cream of the crop ultimately. So you can either buy a whole note, invest non-accredited, buy a whole note, hypothecation for a 1-year term. You can invest in the fund if you find yourself blessed to call yourself an accredited investor for a 10% net paid monthly for a 1-year term or 12% net paid quarterly for a 3-year term. I say net. What does that mean? Because I bill my management fees on top. A lot of people shop other funds and see a stated return and then end up seeing a management fee and a service fee and a buy fee and a sell fee. So really, it's super transparent. My partners in the fund who invest and get a per unit owner share in the debt portfolio make a 10% net yearly for a 1-year term, or maybe even more, depending on how long you want to lock that away. And which I come to find out, you can also invest with IRA. So you can buy a mortgage with an IRA or a solo 401k. You can also invest in the fund accredited with an IRA or solo 401k. And that's all information we've gained from attending these events, associations. I see some love going back and forth from Arizona Real Estate Investors Association, Mr. Mark. So appreciate that. Definitely worth going. We'll have a booth, most Phoenix real estate meetup. And that's at venue 8600 in North Scottsdale. They go over the Cromford as well. But I'm out there with the lights and the cameras. I love to maybe have you on in an interview at any time. Just talk about the market and grow the opportunity. We'll do probably $5 million in transactions this year, and we're raising. So whether you raise private money, whether you want to learn to raise private money, whether you're a private lender, whether you're a real estate agent here in the Valley, with people that fail to qualify for residential purchases, or, all the above. These are areas of opportunity and why we come on here every 2 weeks and go to these different events, go to Azria, headed to DME this week. And we met Smitty at DME as well. That was like 2-3 years ago. And it's crazy to see what's developed over the past 2-3 years, how the opportunity's growing, and ultimately how we're touching larger conversations all within the program. And all of this success has really brought us to the understanding where we really want to participate in an equity multiple of a mobile home park. So our long-term goal is to run our same model and ultimately participate in the equity multiple that these mobile home parks we work in are actually reaping the benefits of our work. We come to find out that we're facelifting communities, turning park-owned homes to tenant-owned homes, and that's a facelift of a mobile home park. So with the fund, our objective here this year is to acquire a mobile home park here in the local market of Arizona and run our same model. So we're currently raising a debt offering in the fund, and we'll offer it to our accredited partners who want to participate in, say, a 3 to 5 year delta, a 7% pref, and a 2x equity multiple on a manufactured home community where we run spin-off notes, we spin off manufactured home sales. There's other return on investment with our model, those two combining, and now we participate in an equity multiple. James, how many mobile home parks have we looked at over the past year?
I mean, in Arizona, there's approximately 3,300 mobile home parks, 1,500 mobile home parks, and there's over 300,000 actual mobile homes in Arizona. That's why we chose Arizona. We happen to live here, which is a great thing. But the big benefits far outweigh any other market. Arizona's consistently a top 5 market in the country, move to market with highest demand. Rental rates stay superior high in the market, and that holds true to keep the demand for low-cost housing completely continues to stay in. One thing that I do want to mention, Alden was talking a lot about Silvercrest Opportunity Fund and all the benefits of it and the different aspects of investing. Now, obviously, not all investors are accredited investors because that's accredited investor fund. You could actually go to our website, and I'll put the link on the chat, which is mobilemailboxmonday.com. You can click on that link, and there's a free sign up. There's no charge to sign up. You can view notes that we have available. We have notes paying ranging from 10 to 14%. You're actually the note holder. One of the questions came in, and Alden kind of lightly answered it, was, let me just go up here. Just note, yes, you are the note holder on title. We make you the note holder on title on the property if you buy a note through us. So you're getting that lien position. So even myself, I used to have notes in other markets like Georgia. You're getting the exact same, overall, the exact same thing. You're getting your secured lien position on a property. If you own a note and you buy it, you're getting the lien position on the property. You're getting third-party servicing, and you're getting the confidence that the property, the buyer has been double underwritten, which is really, really critical, because at the end of the day, if you're a note holder, the main goal is what? To make sure that the note is performing. If by chance something ever does happen, and out of the multitude of notes that we have sold and done, we've had a few that have gone non-performing, we step in at cost, as Alden has mentioned. We step in at a cost basis and help try to strike up and figure out what's going on if the person goes behind on the note, because you always want to figure, find out, well, what happens if something goes wrong? Am I stuck by myself? If you buy a note in a market that you're not in, it's a super challenge. Say we're here in Arizona and we buy a note in Indianapolis on a single family home. If that person goes into default and stops paying, I've got to hire somebody local that I don't know. I've got to get an agent to go knock on the door. I got to figure out if I've hired attorney. In this business model, we have it all figured out. We have a full back-end system, and we do a cost basis program, including the use of our attorney firm that we already have money down on. They're a low-cost firm that does evictions if we have to go through that. Out of the last year, I don't even think that we've done an eviction ourselves. I don't think that we have even one over the last year. We've had a couple of workouts that we've had to talk to people. They lost their job. Something happened. We worked it out with them and got them reperforming. And really, it was no cost to the note holder. We do it as a courtesy, because our main goal for our note investors, for them to buy notes that are successful, so that they'll come back and tell their friends, and more people will come in and buy notes from us. And obviously, as your income matures and gets higher and you become accredited, then you can step in with Silvercrest Opportunity Fund and invest with Silvercrest. So we have individual notes for sale, and you could ultimately even invest with Silvercrest. So those are the two opportunities that we have going on. Author has a question. Go ahead. Somebody had a question. I think it was.
Hi,
Here we go. Go ahead.
can you give me the hi, can you give me the percentage of defaults? Is it 1%, 2%, or
It's 1.5.
Yeah.
1.5%?
Yeah. Pretty. It's very, very low, because the people, remember, they're having to get double qualified. It's not like a single family loan where you get qualified with one lender. You buy the house and you put minimal money down. These people are having to get qualified twice. So it makes the strength of the loan that much stronger.
Out of all the transactions we've ever done, we probably had to do it 5 times. And that's like a total of 300. So, it's about that. It looks like we missed a question in here. What does an exit strategy look like if you owned multiple notes and you wanted to sell to make your bank? Is there notes that banks like more than others? Just curious if they prefer certain terms more than others. So great pointed question from Painted Sky Property Management. I think Jesse there. Great question. Exit strategy on a personal property note. I recently talked to the head of the Private Lending Association nationally, and they have large institutional appetite in tranches of 5 million bucks. So say for the fund in this conversation, that provides us liquidity within a 5-year delta if we ever need to sell a large tranche of notes. That's like 5 million bucks in niche market manufactured home notes, right? So for the non-fund environment, for someone that may own 3 notes, 5 notes, 10 notes, and they want a potential exit or just the option, or maybe just have it be possible for an exit strategy. They don't want to exit anytime soon, but they may want liquidity in 5 years from now, 10 years from now. That's a private lending conversation. So we can teach you the verbiage you need in order to facilitate a few things. Hypothecating with your friends and family and raising at a lower rate than what the original rate was on the paper can teach you to do that. Can also help you navigate selling a partial. So taking out 20,000 bucks and selling a partial to your friends and family, or your contacts you make in Arizona Real Estate Investors Association, or the nationwide lending arenas you're in. Those are areas of conversation that we would love to help facilitate you with, because most people don't know you can re-leverage a note. And, depending on how small a bank is and things of that nature, I've heard some local banks would even participate, depending on what your relationship is with the bank, in re-leveraging that collateral. So, those are all areas of conversation. In manufactured housing is definitely more of a niche. It's not as easily operated in, but we're all here today at Mobile Mailbox Money interested in the opportunity of affordable housing, and affordable housing is going nowhere. It's a big buzzword. It's a state of emergency. The politicians are talking about trying to find solutions, and it's here in manufactured housing of all things. And I think as that grows and that need, starts to continue to grow, that they'll open up, I think, some more institutional lending options like FHA and stuff like that. And that'll provide some potential liquidity, I think, potential for down the road. It could be, them catching on in 10, 15 years, but who knows? So you've got your availability to raise your own money, hypothecate against your notes, sell a partial. You can sell the whole note to another investor. Did you know you could sell a 14% note at a 12% and make a return on flipping the paper? Wow, interesting. Didn't know that. Did you know most notes are 7 to 12%? Wow, interesting. This is 14, really interesting. You could make your living flipping paper from 14 to 12 to other people that want a secured return in a Warren Buffett investment strategy. So there's a few of the exits associative. It's not for so much the layman to invest in a note. There are potential risks. There are potential liquidity issues, but those are all things that come with the higher rate of return. Right. So whether you're wanting to invest that in an IRA and hedge long-term for retirement savings, a lot of investors love that component because they don't want to touch the money. They want it locked up in high yield, secured, stable bank quality assets that, ultimately do what they say they're going to do. So those are the few options. Are families double qualified in Arizona, or is this normal nationwide? We got this last question peppering in here from Bernard. Bernard, for those of you that don't know, Bernard actually does kind of this same model, and so does Mark. I think he left the chat. But they do the same model. There's people doing this business. We're not the only ones. It's not a unheard of situation. It's relatively under the rug. But that provides us the opportunity and golden nugget of procuring more deals out here in the market. Nationwide, I think most communities are institutionally owned. from my understanding, nationwide, most of them. So depending on the ownership, they're going to have their blanketed criteria that they require that I think is kind of market contingent. But the communities really require, I think, nationwide, at least a credit score, no past evictions, verifiable income, no open bankruptcies. And really, no past evictions is the biggest one. They'll probably open up their credit criteria depending on the desirability of the market. But us being here in Arizona, they've really lifted the bar as far as their risk mitigation, wanting to ultimately stave any non-performance of their lots from even an owner-occupied unit. So they have to qualify, just to move in and own the unit. Did you know they can't just pay cash for a mobile home and live in the park? They still have to hit those benchmarks, actually, for community ownership. It's almost like qualifying for an HOA. So boom, huge feedback today, huge pertinent questions. We had Arizona real estate update. We had talked about the conferences we've attended. Just want to mention lightly my Business Network International. If you're not a member of BNI, Business Network International, it's a little fruity here and there, depending on what chapter you go to at the end of the day. But my chapter's the BNI Connectors here in Arizona. We meet every Wednesday at Orange Tree Golf Course at 11:15. I've done about $1 million in transactions from Business Network International in 2-year program, given about 100,000 and thank you for closed business to our other capital partners, my attorneys in there. We had someone, the bookkeeper, train our bookkeeper and things of that nature. So we're always out there. If you're ever interested in attending an environment like that, feel free to reach out. Don't forget, DM me this weekend. Watch for the content coming out. We'll get some takes from other hedge fund managers, from other private note investors that we've come across. Know that this mastermind's every 2 weeks at the same time on Thursday, 12 o'clock Mountain Time. Whole lot of invaluable information. Go back and watch this. I recommend you doing so if you're at all interested in, getting further clarity. I think we went through really the gamut of how we buy, sell, trade, list, invest in manufactured housing, how that fits within the market of pricing, where we see the outlook, how an investor can participate. They can buy in an IRA, they can hypothecate, they can re-leverage their notes. Wow. The amount of information we went over today. So we did about 300,000 in transactions over the past 2 days. I've got $1 million in notes immediately available for your capital investment, whether in the fund, hypothecated, or to buy a note. So if you're a hedge fund manager, a private lender, a note investor, or someone just looking to, maybe learn how to leverage their relationships to raise private money, all information that we've provided here today. I encourage you to go view our previous vlogs with me and Kristian to check out the Cromford reports and things of that nature. If you're needing real estate help, you want to see some comps, want to see some rentals, contact Kristian Berry. Knowledgeable, answers the phone. He's around, so always looking sharp. So happy to have him here today as well. So that's the mobile mailbox money mastermind here with Silvercrest Opportunity Fund. Does anyone have any final questions here at the hour mark? Boom. Went over a bunch. If you feel like you're drinking from a fire hose, it's rightfully so. We went through a lot of information, so go back and view this. It's free education, learning how we operate a multi-million-dollar strategy in originating notes in affordable housing, investing like Warren Buffett. We'll see you guys in 2 weeks. Feel free to reach out to me direct. View our notes immediately available at mobilemailboxmoney.com or invest today at Silvercrest Opportunity Fund. Call us at 602-888-CASH if you need help with anything, or contact Sonny. Appreciate it, everyone. We'll let you go.
Good job. Thanks, Alden.
10% in bank quality notes if the market has you concerned. Accredited investors seeking stable returns. One thing I've learned, being burnt, you gotta invest long term to move the worm into the urn. Turn the page, turn and earn. Earn the page, earn. Learn the way, earn. Earn the pay, earn the pay. Earn the pay, earn the pay. Passive. Really, I think this massive, stable cash flow, lavish, by the finance for the masses, this 14%.
in manufactured housing. Really, all the deals I've been doing, it's kind of hard to keep on counting. Not really.